When we look at individual setups like this, you want to sit down in front of the marketplace right before 8:30, okay? Preferably 8 o'clock, and you want to look at where the highs and the lows are in deference to the 1 minute chart and the 15-minute time frame. So here's what 15-minute looks like here. And if you look at where we came from, see this high at 7 o'clock in the morning? That's this high right there. See it on the right chart? So this chart, this larger chart here, is the 1 minute, and this is the 15-minute time frame. 15, 5, 1 minute. Those are your first three time frames to worry about. But the levels and inefficiencies on the 15-minute time frame, the 5-minute time frame, and the 1 minute time frame. You don't need anything below a 1 minute chart. You don't need anything else to do what I'm going to teach you. Okay? This is what you're doing. You're studying price at specific times of the day. If you're not writing this part down, you're blowing it already. So between 8 o'clock and 8:30 in the morning, New York local time or Eastern Standard Time, you'll always know what time ICT is saying to look for these things to happen, because they're never going to not be there. Write that down again, okay? And underline it. This is always, absolutely, without fail, it's never not going to do it. It's always, every single effing day, it's going to do this very thing. It's going to do it. It's going to absolutely do it, because there is an algorithm, and it does this to spur on emotional interest or tangible orders that are actually sitting out there. Real orders that are sitting above and below or inside of inefficiencies where the market needs to offer fair value to the marketplace. So what is it reaching for? It's reaching for old highs, old lows, and inefficiencies. So you observe price action, and you're looking for areas that look real smooth and safe, where they say peace and safety, sudden destruction comes upon them. Any time that you're looking at price action, and it doesn't matter what time frame you're looking at, it does not matter. This principle is always true. The market will go to an area of smoothness for the purpose of disrupting any orders that would be resting above or below it. We've already mentioned down here. So what we're looking for always is, where is the market smooth on the 15, the 5, and the 1 minute chart? Is that complicated? Nope. What does it look like to be smooth? Well, when you have price levels that create highs, like this swing high here and this swing high here, they're real close to one another. See that? When you're looking for relative equal highs, here's your secret weapon for it, okay? How do you know it's a high probability relative equal high that's likely to get swept or traded through? How do you know that, ICT? What differentiates that from any other? Okay, it's this. If you have two swing highs, if the one to the left is slightly higher than the right, you have a very, very high probability that they're going to want to take it above there. Just like you see here. We have a high, and then the swing here happens to be just a little bit lower than that one. Here's what's going on. This is called priming. Okay, priming is where you continuously create, inspire, or manipulate the expectations of a large number of investors, and they think, oh, it's going to go through that high, but then there's a lot of folks that don't want to see it go there because they went short. So when the market goes up here and stops and turns down, what that does is it creates a sympathetic sigh. The shorts are relaxing. If the shorts are relaxing, what are they saying? They're saying that this is now what? Resistance. So anyone that takes a new short position, where are they going to think that the safest place to put their stop loss is going to be? Right above these highs. Why can we trust that they're likely to take that relative equal high out? Not that it will that session that you're trading, but it's high probability that this will be swept when the second or the one to the right, that swing high is lower than the one to the left. That frames these two as relatively equal. Okay. Same thing is occurring here. We have this high here this high here, this one being slightly lower than that one. So when the market went up like this and we had this drop down, what that causes is a sympathetic sigh. See that? So what do you think it looks like when we have relative equal lows? What would be a high probability relative equal low that the market is likely to draw down and go below? It would be a low that has a slightly higher low. In common terms, it's referred as a failure swing. Okay, so a failure swing. Now a lot of people say, "Oh, see, he's just reinventing." No, see what you're trying to trade that. That's what a failure swing is. When you're trying to trade, long or short on that second pass that doesn't take out the low or take out a previous high. That's selling short a failure swing. Okay. What I'm teaching you is how to identify in price action where the algorithm will refer back to and why. What are the central tenets as to what the algorithm is referring to at a specific time of day, most important, and then it refers back to these because, okay, it sees this high based on time, and then the high prior to that one is here. So it's very simple for the algorithm to call that information as an array and say, okay, this high was at this time, and this high was higher prior to it, and they're in close proximity. What's the filter? I'm not going to tell you that, but it's not very much in terms of difference between the price. And when you have that element, the market will invariably start marching back to those levels. It does not matter how many buyers are buying the market to go up there and how many short sellers. Okay? It reaches to these levels because it's coded to do this. And if you do this for a couple weeks, you're going to see, oh wow, yeah, this feels artificial. It feels like it's designed to do these types of things because it tends to repeat every single day at specific times of the day. It will do this. Now let me go back to the times element. Every day between 8 o'clock and 8:30 in the morning, you want to sit down and determine where are the smooth locations in price action on the 15-minute, the 5-minute, and the 1-minute. Let's go down to a 5. So there's a lot of liquidity that's sitting at 17,820.75. Now, real important, it does not mean that it has to happen during that session. It does not mean that. But these individuals will say, I need you to tell me how to make sure that I don't have this wrong. I only want to take this pattern. So how do I avoid taking losing trades with a inversion fair value gap or a mitigation block or the breaker? How do I know if it's a breaker or if it's a shift in market structure? Well, that's easy. You have to have a higher time frame premise and a directional draw where the market's going to go. And if you think it's going to go higher, when you see the market creating a short-term turn, we have the relative equal lows here, and the market drops. You see that? So this drop down here, every up close candle on this time frame, all of this right here, that is your breaker. The most sensitive candle or range is going to be the last up close candle. That's this range low. And see where the body stopped right there? That is your bullish breaker. But the range here from that up close candle that starts all these consecutive up close candles, all of that is technically the bullish breaker. But the most sensitivity is going to be seen in that last up close candle. So the turn here at the bodies, that tells you what? It tells you the narrative. So what is it going to do? It's going to go higher. Okay, so what at that time would you focus on? Well, you have this short-term high here. The inefficiency that's traded to there. We want to see it trade above it and then act as what? Support, which would be a what? Inversion fair value gap. To do that, what would it reach for next? This high and this inefficiency. Does it do that? Yes. What are the bodies doing? Stopping just at that same level here. And more specifically, see that little separation? You have to include that volume imbalance when you have a fair value gap, whether it be BISC or CIVI. Or trade inside the inefficiency. It wicks above it, but look where the bodies are stopping. And look where the bodies are over here. Where's liquidity at? Below here. Nothing in here. This is all very balanced price delivery because it's back and forth. Every other candle is overlapping the highest high and the lowest low, pretty much kind of like coloring it very, very, very good. Back and forth. All this price action is back and forth versus then we have all these run where we have separations in here, back down into that breaker there. Now also notice that we've created again high, lower high, high, lower high, but real close to one another. When did it form? Prior to 9:30. So we have 8 to 8:30, and then you study 9 to 9:30 because it's going to do what? It's going to look and seek the liquidity or inefficiencies. So here's 9:30 there, forming on the bullish breaker. It trades down, and then we have relative equal highs here. So we have these relative equal highs, this high and that high, relative equal high, and we have this area up here. So if the market's going to do what? If it's going to make a punishing move towards the shorts that want to see it drop, because the market has dropped early on, 7 o'clock in the morning, okay? And we have all these very clean levels. What did we just do here? We have a low. It was traded down into. It disrupted this little area in here. So it's made this area jagged. Remember I was saying earlier where the market's real smooth over here versus what it was doing down here. Where has the work been done? So we had these relative equal highs swept here. See that? Case study, bullish breaker to there. But the point is this. The very, very first thing you're doing as an undeveloped, unrefined trader, the idea is that you're looking for the smooth areas where the price is so obviously being defended and being presented and being offered for retail-minded trades. See, I don't look at charts. I absolutely don't look at charts and think of what retail pattern here I can use to get in sync with a price run. Look at that beautiful delivery right to that volume imbalance there, which is inside encapsulated in that SIBI. Went right to the high of that. Now, when you're looking at price, you're looking for the obvious, very, very, very smooth relative equal highs or relative equal lows. How do you know which one they're going to go to? How can you trust? How do you determine which side of the marketplace it's going to reach for? Because what this is going to do, it gives you the initial building blocks to understanding bias. You know, when we're looking at areas that are very smooth, because if you can frame an idea of why the market's likely to draw to a high or a low or inefficiency that is completely visible on 3 time frames, that means you have 3 time frames telling you, hey, pay attention to me. And if that time frame or those time frames are in agreement with a relative equal high or a inefficiency above the marketplace, that means like something like this right here, or this right here, or this right here. They're all stepping stones. Notice that? They're all stepping stones. Inside the context in your overall narrative that the market was going to go here. But 7 o'clock is a very key time. That starts what? The morning session. It matters not that we're trading Forex or futures. The morning session, AM session, starts at 7 o'clock in the morning, New York local time. So your key times are this. 7 o'clock in the morning to 7:30. In that 30-minute window, you're going to look for relative equal highs and relative equal lows that have happened prior to 7 o'clock. Okay? And you're going to be looking through the time frames of the 1-minute chart, the 5-minute chart, and the 15-minute time. Since the 15-minute time frame is pretty static, you only need to refer to it once in the morning. Then what you're doing is you're watching between 7 o'clock and 7:30, or 8 o'clock to 8:30, or 9 to 9:30 opening bell. You're looking for where is the market smooth? Because still waters invite rocks. So What's the market going to do? Every single session in the morning, you have 3 opportunities. And you don't have to trade in the afternoon. You don't have to trade the London session. You have 3 opportunities in the morning to set the stage for a run that will build, if you don't have any understanding about bias, okay, if you don't know what direction the market's going to move in, when all you need is a match, this is a flamethrower. It's the thing that makes every playing field even. They cannot hide it from you. They cannot hide it from you. You're never not going to be able to see it. It's always there. And in plain terms, it's this. If you can contrast one side of the marketplace against another, let me do this. But when you set up a framework of whatever you're going to study in the morning, if you're going to trade the morning session, your key times, you have to absolutely be in front of the charts between 7 o'clock and 7:30 in the morning, always New York local time. Okay? If you can be in front of the charts by 7 o'clock, this is what you're doing. But if you can't, you do the same thing at 8 o'clock to 8:30. The same thing at 9 to 9:30. Okay? This is your pre-market range. Write that down, because if you don't write it down, you're going to forget. You're going to call it the opening range. It's not the opening range. The opening range is the first 30 minutes after the opening bell. At the New York session, the first 30 minutes after 7 o'clock to 7:30, that is your pre-market range. 7:30 to 8 o'clock is your opening range. And obviously the 9 to 9:30, that's your pre-market range. And then post 9:30 to 10 o'clock, that's your opening range. There is no 15-minute opening range. I don't care what anybody tells you. Okay? It's a 30-minute opening range. That's algorithmic. Okay? So what you're doing, and this little range here that's being shown here with this rectangle, what I'm saying is this is essentially that 30-minute interval, whether it be 7 o'clock to 7:30 or 8 o'clock to 8:30 or 9 to 9:30, that pre-market range. In that range, what you're doing is you're looking at this line or beginning of that shaded area would delineate the 7 o'clock or the 8 o'clock or the 9 o'clock, where it begins at that specific top of the hour. And then this would be the range that makes up that first 30 minutes. Prior to that range, anything before or to the left of this, you're looking for equal highs or equal lows. Which side has it? Because that's your bias. It's going to draw to that. How do you know? If you have both. Because I heard you're thinking it. But what happens if you have a relative equal high here and a relative equal low here? Which one are you going to go for? You wait for the first one to get disrupted. Because once that happens, then you work to the other one. That's your bias. So you have to defer and wait. But today I gave you a clinic on how to determine bias, how it's easy for me and it's easy for you. Whichever one has the relative equal highs or relative equal lows, that's a smooth area. It will be disrupted. Anywhere where you see jagged edges like this down here, see how it went jagged and then ripped higher. What's it telling you? What's it telling you? I'm going to look for buy side liquidity, buy stops. This has been a trap. They engage traders to go short. They're trapped short on a breakout. Or they're not trying to take the shorts out of the market yet. And that's why you see all of this in here, a little bit creeping up. This is all balanced. That's why this spike stopped right at the top of the breaker here. Isn't it interesting? If we have this segment of price action, okay, if I'm identifying this area up here, okay, more specifically, let's be honest, because this is the one I drew your attention to first, so we'll stick with that one. Every single day, you break down the chart starting at 7 o'clock in the morning, have 7 o'clock in the morning, all the way till, say, 11 o'clock. Okay, so it's 4 hours. And you want to have your 15-minute time frame, your 5-minute time frame, and your 1-minute time frame charts. And annotate. And it may require you to have multiple charts from that individual 1-minute chart where you're zoomed in and you're annotating something specific that are very salient to you. Because most of you may not have trusted this as a bullish breaker. When you saw this drop in here, you're hoping, and some of you were probably tickled, your asshole was puckering, thinking, I know. If you go back through all of this price run here, okay, what you're going to do is you're going to focus on the points that make the most obvious sense to you, that you could see and it says, you know what, I understand this. Even though ICT pointed out this breaker, you may have noticed it, maybe you didn't. If you didn't, that's not your PD array. If you noticed that it traded down into this fair value gap right there, inside of this old SIBI, which is essentially where? That midpoint between where we expect price to trade to, which is above these highs, and where it traded from. See that? So if we see where it's likely to go and where it went from, where it originated from, where's the midpoint? Well, let's do a simple measurement. Here's your fib. And we're going to say something above these relative equal highs. We'll just randomly pick an area right there. Okay, simply that. Okay, so I'm not trying to complicate anything. But if you take that and you go down to the lows that are relatively equal, not the lowest low, that's the manipulation. You want to use the relative equal lows like that. Okay, you see that? And then you have essentially the midpoint here. In close proximity to that, you have this fair value gap and you have this fair value gap. And this one here can be used, even though it's a little bit above equilibrium, because we didn't take this high and that high out, which I was outlining to you real time. We didn't take that out yet. We didn't take out these two relative equal highs when it was trading down to the breaker. But what happens when it trades up here? It takes off and runs to where we were waiting to see it deliver. The smooth areas are going to be attacked. The sharks are going to go to the still water. That's where they're going to go. Why? Because as soon as someone in there starts shaking in fear that their stop's going to be taken, that still water will ripple, and that triggers a frenzy, and the sharks are going to go right there. You don't trade into levels where the sharks have already had a frenzy, and that's down here. Okay, they've already done the work. There's been an attack down here. How do you know? There's been the great disturbance in what price was doing and how it was delivered. It's jagged like shark teeth cutting through the side of a whale's body. It's been damaged delivered. You can see it. It's physically represented in the jaggedness of the swings going down, where we don't see that jaggedness up here. It's nice and smooth, real inviting. It's safe. Put your stop loss above me. Like a siren calling out to the sailors. Come to me, and he crashes them on the rocks. But you have to go through all of this price action in here and determine what price level makes sense to you. Which one resonates with you? Do you see the fair value gaps where I was outlining before I did it? Did it make sense when I was drawing them out? Did you change your expectation and get fearful that I'm wrong and it's not going to go up there because it did this drop here? What's occurring here? The only thing it's doing is at 9:30 during the opening range, it's doing what? It's creating a Judas swing. Something that's opposite to the real move. The real move was given to you with these highs. It's going to go there. But anyway, we can see how that SIBI becomes an inversion fair value gap here. And then it sends price higher, retraces down, and then you have your second leg redistribution, and then sends it to the smooth area that makes up this market maker buy model. So when you're looking for the bias, okay, the easiest, most scientifically proven, 9 out of 10 doctors approve, ICT has nailed it down to a science of wherever the smooth equal highs are or smooth relative equal lows are at the beginning of 7 o'clock to 7:30 or 8 o'clock to 8:30 or 9 to 9:30. You have 3 opportunities, 3 chances, okay? As each one of these time windows passes by, so at 7 o'clock, we formed the relative equal highs. And then at 8 to 8:30, we didn't go up there yet. So that means that, 9 to 9:30, chances are that's the run. See how that does that? It increases the likelihood of it going there. It doesn't diminish it because it's building up more trust in that area right there. So the framework begins at 7 o'clock in the morning. Start looking for relative equal highs to form. Not before. Key takeaway is not before 7 o'clock. At 7 o'clock, look for them to form. Big takeaway there. Okay, if you're looking for relative equal highs prior to 7 o'clock in the morning, you may get it, but many times you're expecting the London session to be completely overrid, and it's most times not the case. So it kind of like builds in this filter where you're not trying to demand that the run on London is removed or dismissed because of price overlapping it and going back over top of it. Because the general consensus is we could see the higher low of the day form in London. So if it's bearish or bullish relative to a higher time frame draw, which is not necessary. Notice I haven't even used that here yet. Only thing I used was a 15-minute time frame, a 5-minute time frame, and a 1-minute time frame.